Hello, everyone. Today is Wednesday, September 17, 2025, and I'm Brian Tokuuke, Portfolio Manager at the Rice Partnership. Joining me today is Tyler Sanchez, our Financial Planner and Research Analyst here at the Rice Partnership, who's going to share his expert knowledge on what we're doing in the international equity space. Tyler, thanks for joining.
Thanks, Brian. Hi, everyone. As Brian said, my name is Tyler Sanchez. I'm a financial planner and research analyst here at the Rice Partnership. And one of my sectors that I focus on is our international equities. With that, I'd like to start with taking first a 40,000 foot view at our international benchmark, which is the MSCI All Country World Index X US companies, which is outperforming the S&P 500 by 10.85% as of August for the year. It's a 21.64% return for the benchmark versus 10.79% for the S&P 500. With that being said, valuations also in foreign markets remain much more attractive than US stocks, which are trading historically expensive. As a result, we've expanded the international subsector from a 10% weighting to 13%. There's also a chance it will be moving a little higher again in the near future. Our emphasis so far has been on bolstering our Eurozone exposure, especially with a country like Germany, which has done away with their fiscal debt brake and will significantly increase fiscal spending on infrastructure and defense. This increase in defense spending is due to concerns about continued US support for NATO amid the Ukraine-Russia war. Further support from the euro has allowed the European Central Bank to cut interest rates, which has buoyed equities amid trade tensions. We also see improving economics, strong earnings, and corporate governance reform, which is supporting our international holdings. Thanks, Brian.
Thanks, Tyler. And I'm just a couple points about what we're doing on the fixed income side. One thing we've done is we've transitioned from JP Morgan's Global Bond Opportunities Fund, or GBOSX, and moved into JP Morgan's International Bond ETF, or JPIB. We feel that it's a seamless transition as both funds are under JP Morgan's family of funds and is essentially the same portfolio management team running JPIB that was so successful with GBOSX. The reason for the change is that JPIB increases our international exposure by about 30% from GBOSX as the ETF tries to invest at least 80% of its assets in foreign fixed income. In addition to what Tyler mentioned earlier, what we like about investing abroad is that a weaker US dollar can help boost returns as foreign currency can now buy back more dollars. According to the Bloomberg Dollar Spot Index, the dollar is down about 9%. And that is largely due to our ever-growing debt burden and political interference with our economy. The dollar could further weaken as the Fed Reserve cuts rates as lower yields make Treasury bonds less appealing, at least at the short end of the Treasury curve. JPIB also limits our exposure to long US Treasury bonds, or bonds that are 10 years and longer, which we currently are not big fans of. The Fed Reserve has less control of the long end of the maturity range and is more influenced by economic factors. Our lack of enthusiasm is due to reasons mentioned earlier: country's debt burden, inflation risks, and concerns over an independent Fed Reserve can lead to yields on long US Treasury bonds drifting higher, which lowers its value. Well, that's about all the time we have today. I'd like to thank Tyler for joining us today and providing your expert knowledge on the international equity market. And to everyone tuning in, thank you for joining.
Thanks, everyone, for joining. Bye for now.